Exchange-traded funds, short for ETFs, are seeing massive growth where over the past few years, investors have been adding significantly more money into them. Now, if you don't know what an ETF is, it's pretty much a way to buy hundreds to thousands of different investments all within one purchase. And as you can see by this image, ETFs track a variety of assets like equities, fixed income, commodities, and many more that make ETFs intriguing to all types of investors. Not to mention, but ETFs are very easy to trade as they have the same structure as individual stocks. They are known to be very tax efficient, and they also make diversifying your investments super easy to do. Knowing that, my name is Sully, and while this is not financial advice and you must make your own financial decisions, if you do find value in this video, all I ask is that you consider hitting the like and subscribe button for future content like this. With that said, the first rule to go over is to understand what you own. Now, I'll go over particular tools and resources later in the video that can help you pick the right ETFs for what you're looking for, but a quote I like here from one of the best investors of all time, Warren Buffett, was when he said, "I don't buy what I can't understand." While Warren Buffett invests heavily into individual companies, he's also spent his entire life learning and understanding the underlying value of every business that he invests into prior to making a decision. And because of that, it's pretty much the reason why he suggests to the ordinary investor that the best way to own common stocks is through an index fund. An index fund pretty much means that you are able to passively track a particular market. So if you were to buy an S&P 500 index fund, your investment is tracking 500 of the largest publicly traded US-based companies, where you can get instant exposure to top companies like Nvidia, Microsoft, Apple, and many others you probably heard of, all within one purchase. So to get ownership in all these companies at once, you could get an ETF called the Vanguard S&P 500 ETF with the ticker of VOO, and there are many other alternatives you may want to consider. Of course, there are many other factors to consider prior to buying an ETF, but I mention this because every ETF is different. Some focus on just one sector like semiconductors, a particular country like the US, certain trends like innovative technology, or even particular assets like bonds or gold. And if you don't understand each one and how they match your needs, properly diversifying a portfolio is going to seem really confusing, and you're likely to have less confidence with your decisions. Knowing that, let's move on to the number 2 rule, that is keeping cost low. By keeping the cost low on your investments, this could easily save nearly anyone watching this hundreds of thousands of dollars over time. The reason is because your investments compound over time, and when we look in terms of decades, the impact from fees becomes massive. For example, if you have an initial $10,000 and you start investing $500 per month into the stock market, averaging the benchmark of 10% per year with a 1% annual expense over 30 years, that could cost you $210,000, resulting in an end portfolio of $950,000. But if you instead put that into a low-cost index fund like the S&P 500 I mentioned earlier, VOO, that has a 0.03% expense ratio, with the same example just mentioned but now with VOO, the total cost after 30 years would be $7,000, resulting in an end portfolio of just over $1.1 million. Now, that difference could be even larger depending on what you buy, what types of accounts you use, how you use them, and if you have others managing your finances. But all in all, the simplest way to keep costs low and improve how much you keep in your pocket over time is to manage your own investments and invest into low-cost index funds. Index funds are at the forefront of the content I create and the new startup that I'm working on, and one interesting article I came up on from CNBC says how all you need is one fund to build wealth over time, mentioning a total stock market index fund. But I want to emphasize the fact that index funds don't employ a high-priced manager or team of analysts to run things. They have very few costs and therefore come with much lower fees. This is just one of the main reasons why the majority of my investments are broad-based index funds, which typically stay under 0.05 to 0.1% of an expense, which is super cheap, especially for what you get out of it. But in order for this rule to really have a strong impact for your financial future, you have to follow the rule number 3, that is to think long term. So by following the second rule of keeping costs low, you may very well want to invest into broad index funds where you can now be exposed to the majority of publicly traded US-based companies all within one purchase. The true benefit here is that you are reducing the risk of relying on one company's performance, but rather that you are taking a bet and investing into the entire US economy or whatever other markets you invest into. Even better, the US stock market specifically has historically proven to do very well for investors, and an article by BlackRock points out about long-term investing that time in the the market can top market timing. In fact, for the US stock market, $1,000 from 1926 to the year of 2024 would now be worth over $15 million. And even crazier, if you played around with your investments and missed out on only a few of the best performing days, your returns declined significantly. The data shows $10,000 invested into the S&P 500 for 20 years, and if you missed just 5 of the best performing days, your returns declined from $70,000 to roughly $45,000. So not only do you need to think long term, but you also have to avoid thinking short term. Because we're all humans, we all have emotions, and there are a ton of studies showing the psychological mindset when investing in the markets with all the ups and downs, where if you were to start, you may be encouraged to invest. Say the market goes up, you gain some confidence, then it goes up even more and you're thrilled. And if the market continues strong, investors become euphoric and start buying in more and more, not realizing that it's a high market. Then all of a sudden comes a dip where you become surprised, the markets fall more and you become nervous, and as it drops more, you then become really worried. And after that point, you may hit the panic button and sell at the bottom low. All in all, the beginning is the hardest part, but if you believe in something like the US economy and that it's going to continue developing over time, broad index funds like a total stock market ETF like VTI or an S&P 500 index fund like VOO could very well provide strong returns for you over a long period of time. This leads me into the number 4 rule, that is to follow your gut. Realize that no one can tell you what the best investment is. You may hear certain stocks are trending or popular index funds like ones I'm mentioning, but in the end, you have to make your own choices. Personally, I believe broad index funds are great and super easy for the majority to invest into long term. They've proven historically to do very well and provide plenty of data when researching, but you may rather pick other investments, other stocks, real estate, or other ventures that you'd rather pursue. But most importantly, if you follow your gut on something, you're likely to have more confidence with your decision. And I truly believe that the best way to learn is through experience and at least getting started in the direction that you believe can be best for you, and you can learn from there. In fact, at the beginning of my investing career, I tried to trade individual stocks to outperform the market, but I realized that I would have done better if I just bought the strong index funds that I own today. And so to improve the gut feeling you have with your choices, rule number 5 to follow is to diversify wisely. You see, the goal when it comes to investing is to maximize your potential returns, yet minimize the downside risk. For instance, to have the opportunity to outperform the market, you have to take on more risk. So if you invest into your 5 favorite individual stocks, you could potentially grow your portfolio 50% in 1 year, but your portfolio could also decline 50%. Where on the other hand, if you are nervous to invest and you would rather put everything into bonds, you may return 4% after a full year, but your portfolio would also have significantly less risk to lose money. Except to me, your portfolio now has even more risk because depending on your position, you could easily be missing out on many more opportunities to earn much more. This is exactly why you need to follow and connect all 10 of the rules in this video, because something like understanding what you own can help you decide things like how much you should have in stocks when compared to bonds. The legendary investor Ray Dalio heavily emphasizes the importance of diversification, where he came up with a simple 5-fund portfolio called his all-weather portfolio that consists of long-term bonds, US stocks, intermediate-term treasury bonds, commodities, and gold. Which, if you want to see other investment portfolio ideas, I've created an entire spreadsheet on some of the most popular ones that I'll have completely free for you, linked in the description below. But all in all, rather than going all in on one stock or relying solely on bonds, understanding your position and allocating your savings to the right areas can really help your investments grow properly and reduce significant risk. Now, as you invest long term, the next rule can save you a ton of money, and that is to avoid the hidden enemy. Now, the hidden enemy here I want to bring to your attention is from dividend investments, because whether you reinvest dividends or not, taxes are going to be triggered to you. This can impact what is called tax drag, which simply means as you invest over time, you are going to have a tax burden that is going to drag down your returns over time. I recently made a video covering this in more detail, but a simple example to show you is with an income producing ETF like JPI, and let's say averages roughly around an 8% dividend yield, where if you were to invest $100,000 into this fund, you would generate $8,000 in dividends in the first year. But don't forget, those dividends do trigger taxes whether you reinvest them or not. To keep things simple, because JPI is a high income producing investment that uses option strategies and other methods to get the income, let's say that 80% of it is triggered as ordinary income, where the other 20% could be qualified dividends, which means they could be taxed at better rates. All this means is that the $8,000 you earn in dividend income, whether you reinvest the dividends or not, you could be charged just over $1,600 in taxes by the end of the year, which is roughly a 1.6 0.65% annual tax drag, which by the way, that excludes any state or local taxes and assumes an annual income of $80,000. Where if you were to invest into a lower yielding ETF with strong companies like the S&P 500, using Vanguard's VOO as the example, all the dividends could be treated as qualified dividends if you hold it long enough, and that means that they could be taxed in the long-term capital gains tax bracket. And so with an average 1.2% dividend yield, that would trigger $1,200 in taxes, and with 15% of a tax rate, that would be $180 in taxes, making the total drag on your investments in that year decline by 0.18%. All in all, depending on the investments that you choose, the tax drag could be significant, and as I mentioned earlier, the difference in the choices you make could easily cost nearly anyone watching this hundreds of thousands of dollars over time. From there, rule number 7 is to ignore the noise. Most of you have probably been told by friends, family, or have seen online to buy hot trending stocks before it's too late, but in the end, most of the time it leaves you with regret. One of the biggest lessons I've learned about successful investing is that you have to cancel out what others think you should do and follow the rule number 4, that was to follow your gut. You see, by the time a stock or crypto or any investment has gone mainstream with a ton of noise saying to go out and buy it before it's too late, it pretty much leads you into the path of euphoric emotions and why most investors buy high with later regrets after that makes most sell low. And once you realize that distractions aren't worth it, you then have to follow the rule number 8, that is to stay consistent. Whether you're eager to lose weight, develop a skill for something, build a business, or the goal of this video that is to properly build a strong foundation with ETFs, the most important trait that I've found that leads to success is to stay consistent in what you believe in. When it comes to investing, the term that many refer to for this is called dollar cost averaging, which pretty much means on a recurring basis, you are consistently investing into the market. And even though you probably heard something like this before, say you started at $0 and consistently invested $500 every single month into a broad US stock market index fund throughout your entire career, then you would end up having just over $2.5 million. So aside from consistency, the number 9 rule is to keep your portfolio in check. All this means is that every now and then you want to check your investments and see how much they've changed from your initial target allocation. The keyword here is called rebalancing, which means you buy or sell more of certain investments in order to get your portfolio balanced again. This is typically recommended once per year, but it varies based on your position and how you invest. But all in all, this pretty much helps you ensure that no particular assets are moving out of your ideal amounts. For example, you may have 70% of your portfolio in stocks, then 30% in bonds, and if you don't check for a few years, your stocks may very well be at 90%, leaving you at more risk than you initially anticipated. But checking every couple weeks to months and rebalancing every year or so doesn't take much time at all, and if you can find a way to avoid selling and triggering taxes, whether that be to invest more of your own from cash or using dividend income, that of course would be the best option. Knowing that, let's finish this off with the last rule, that is to never stop learning. This reflects back to being consistent, but the best part of all is that if you keep trying to learn new things, all you're doing is stacking your knowledge and becoming more aware of important concepts, which of course can help you make smarter choices going forward. But when it comes to learning more about ETFs, a few resources I personally like to use include the Source ETF database, where you can see things like the largest ETFs by the amount of assets, the ETF Research Center that shows the amount of overlap between 2 ETFs, or Portfolio Visualizer for different analysis tools, or even an ETF screener tool that many brokerages like Fidelity and Charles Schwab offer, or even the free versions like ones online like ETF.com, where you can filter out potential ETFs based on your interest. Now, if you want to learn more about ETFs, how to invest and pick the right ones, or even some of the best ones that you may be interested in, I'll have other videos and resources that I created linked in the description below. Not to mention, but if you want to get started with a new investing platform, I'll also have a direct link to some of my favorite ones as well, which depending on the one you choose, I may earn a commission for it, which is greatly appreciated. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.